Hello friends, welcome to Bankers platform. So today we will be discussing section 4.3, that is export finance post shipment credit. So this video will be helpful for certificate course in foreign exchange exam and also for international trade finance. So for both of the exam this topic is common. So let's discuss, and already we have discussed this topic through master directions of RBI. So you can also refer to that video because that will give you a insight of the RBI regulations also related to post shipment credit. Okay, so here it is export finance post shipment. In previous video we have discussed section 4.1 and 2. In that we discuss about the pre shipment finance. So here pre shipment finance that we have discussed, and today we will be discussing post shipment finance. Okay, so pre shipment money given before goods are shipped for buying raw material, production, and packing. And now the concept is post shipment. So, what is post shipment? Money given after goods are shipped. So, once the exporter has shipped the goods, after that, whatever the credit facility will be given, that will be called post shipment finance. Okay, so money will be given after the goods are shipped and until the exporter receives payment from the foreign buyer. So post-shipment finance act as a bridge between the date of shipment and time payment is received. So it usually comes in the form of loans, advances, credit from the banks. So what is the definition? So post-shipment credit means any loan credit given by a bank to an exporter from the date of shipment until the exporter actually receives the payment. So for this period, the advance, whatever is given, that will be called post-shipment finance or credit. So why do exporter needs post-shipment credit? So very simple, that after shipment, what will happen? The earlier packing credit, that is pre-shipment loan, must be closed. Because as this shipment is done by the exporter, then it is must that pre-shipment loan, that is packing credit, must be closed. So the goods are no longer with the exporter. So the bank cannot keep them as a security, because whatever the loan given by the bank for the raw material, so that raw material is converted into finished good. And now that material is no more there because it has left the country. So it is important for the bank to close the pre-shipment credit, that is packing credit. Okay, but exporter still needs the money for any expenses. So while waiting for the buyer to pay, so for this purpose, post-shipment finance help them to repay their earlier pre-shipment loan to provide working capital until the foreign buyer pays. So what will happen that suppose one exporter has taken the PC. PC he has taken, then he purchased the raw material, and after that he created the finished goods. Finished good is done, then he will do the shipment. So once he do the shipment, then he will approach the bank. Okay, then he will approach the bank with the shipping documents, BL and all bill of exchange. Those documents he will give to bank, and now bank will purchase the ship this foreign bill. Okay, bank will purchase the foreign bill, and whatever the proceeds will come, that proceed will be used to close the PC. This packing credit will be closed, and now whatever the outstanding is there, that will be of post shipment. That outstanding will be of post shipment credit. And in some case, this is the case where the exporter has taken the pre-shipment loan. But if any exporter he has done the like all the pre-shipment work on from his own fund. So once he has done the export, so he will go to the bank. He will submit the documents like bill of lading, bill of exchange, okay, invoice, packing list, certificate of origin. All documents he will submit to the bank with the request to purchase the bill. So what bank will do? Bank will purchase the bill for 80% of the value or 90% of the value as per their sanction terms and condition. and then the bank will give the credit to the exporter. Once the exporter receive the money, once the money will come, so what will happen that that foreign buyer, he will send the money to bank only. So bank, what bank will do? Bank will close its liability, that bill payment and balance. Like suppose bank has financed 80% of the bill amount, so 20% amount bank will give to the exporter. So in this way, this transaction will be done where the exporter has not taken any pre-shipment credit. Okay, so what are the features of the post-shipment finance? Purpose, already we discussed, provides short-term funds between shipment and payment, helps exporter meet salary, raw material cost, and other obligation while waiting for the payment, and self-liquidating nature. That is a, already we have discussed, it will self-liquidate. The loan is repaid automatically when export proceeds come from overseas buyer, buyer's bank, and insurance claim from ECG if default. Duration. So duration of the, normally it will be up to 270 days from the date of shipment and can be extended up to 365 days in special cases. If payment still doesn't come, the loan is treated as normal domestic loan and concession like lower interest rate that are cancelled. So this you have to remember. If any like loan is given in that, if the payment is not coming, if the payment is not coming within 365 days, so whatever the lower interest rate is applied on the like export credits, so those all the benefits will be cancelled. That benefits will be cancelled, and it will be treated as a normal domestic loan, and higher interest will be charged. And other facilities which he would have got, like less processing charge. So many things are there. So that facility he will not be getting if the payment is not coming within 365 days max. Okay. So usance bill over 180 days. So if export bill gives the buyer more than 180 days, it is treated as a supplier's credit and follows separate rule. Margin requirement. So bank usually keep a margin like 10 to 25%. That margin will be there to ensure exporter share some risk. Okay. So margin depend on the product, time given to buyer, and exporter's reputation. So these things will matter for the margin. So types of post-shipment finance. So first is purchase of export bill. So we will like purchase the export bill for side bill. Okay, payment immediately on demand. So bank purchase the bill and gives INR to exporter. So bank takes currency exchange risk, and this is called foreign bill purchase (FBP) or export bill purchase (EBP). So every bank has their own terminology. So some bank may be using like FPB, or they are using EPV. So that depends on bank to bank. Okay, how they are doing. Some banks will they will say foreign bill purchase FBP. Okay, so that type of also available. Okay, other is discounting of the bill. That is usance bill. Usance bill is there. That is credit period is given for the export bill. In that discounting will happen. For usance bill, discounting will happen. For site bill, purchase will happen. Okay. And banks pay exporter immediately after discounting the bill. So this bill will be called foreign bill demand, foreign usance bill discounting, and EBD. So mostly in Finacle, I have like worked. So in Finacle, we are using the menu MEOB. So you can also tell which menu you are using when you are doing these foreign bills. Okay. MEOB will be used for all the export bill transaction, and other ID will be MMIB. That will be used for import bill transaction in Finacle. If you're using the Finacle software in your bank, so these menus are available for doing the transaction of export bill. Like if you're sending outward payment, and HORM will be used. If you're doing inward remittance, then HIRM. So these are various menu. Like if you are working related to letter of credit. So IDCM and ODCM. So these two menus are, this is for outward and this is for inward. So these various menus are there that will vary from bank to bank. Just I gave you one idea. Okay. So next is that negotiation. Negotiation will be called when it is under LC, because when we are taking the rate, so While taking rate, there are three types of rate will be available: for purchase, for discounting, or for negotiation. So purchase will happen when bill is site bill. Okay, demand bill is there, then we will purchase the bill. If it is usance bill, where some period is given, like 30 days, 90 days credit is given, so then we will discount the export bill. And if it is under LC, then it will be called negotiation of the bill. So if export is covered under LC, so bank negotiates and pay exporter in advance. So that is called FB and EBN. Okay. Other is that rupee finance against bill on collection basis. So sometime on collection basis, the bill will be given. So then exporter sends bill on collection, bank give INR advance, but exchange risk remain with the exporter. Advance against consignment export. So here it is used when goods are sent for approval, like gems or jewelry. So since sale is not confirmed, banks keep higher margin, like up to 50% margin will be there if it is a consignment exports type of bill. Advances against undrawn balance. Like sometimes 5 to 10% of the payment is retained for installation or inspection. So for that also banks can give the advances for balance for up to 90 days only they can give. Advances against receivable from government. Like exporters, they get the incentive like duty drawback, RODTEP, GST refund. So for these things, time will be taking. So for that gap, that period, the bank can give the loan against these expected receivables. So other is concept of notional transit period and notional due date. So these are the imaginary period fixed by the banks to decide due date and interest benefit. So they run from the date of advance when bank gives money until the expected date of payment, not linked to when goods reach the buyer, because that is not in the hand of the bank. Like some shipment is done on 1st January 2023. So bank purchased the bill on 11th Jan. So what will happen if it is a site bill? So site bill non-LC. So NTP is 25 days. This is the FEDAI rule. That normal transit period is 25 days. So due date, what will be the due date? So due date will be 6th Feb. 6th Feb will be the due date. Okay, next is crystallization of export bill. So crystallization means that suppose the bank has done like if exporter does not get paid by due date. So if due date is 10th of November. If due date is 10th of November 2025 and payment has not come, so what bank will do? Bank will convert the foreign currency loan into rupee loan. Because suppose bank has discounted for USD 9,000, but payment has not come, so crystallization will happen and this 9,000 will be converted. This will be converted into like rupee in INR, in rupee credit. Okay. So this protect the bank from currency risk and exchange loss is charged to the exporter. So done usually after 30 days after due date. So suppose due date is 10th November and payment has not come up to 10th December. So bank will crystallize the bill. Recovery of post-shipment credit. So normally recovered from export proceed. If buyer delays, exporter can request extension up to 365 days. And if still unpaid after 365 days, the loan becomes a domestic loan and penal interest is charged and exporter benefits taken back. Okay, post shipment finance in foreign currency, PSCFC and EBRD. So just like pre-shipment finance can be taken in foreign currency, so exporters can also take post-shipment in foreign currency. Here also the rate will be lowest internationally and it is cheaper. And if an exporter already took PCFC, then PSCFC is compulsory to avoid forex mismatch. And bank can also rediscount these bill with foreign banks to get liquidity. So this is all about the post shipment. So here is the recap. Recap is that only what we learned now. Post shipment is equal to short term loan after shipment until payment and need to close pre-shipment credit and provide working capital. So same things are there. And here simple case study is there, which is self-explanatory. You can just read it and have a look on it. And here one discussion. So I hope so you have understood this post-shipment credit. Already pre-shipment is discussed. And if you want the deep knowledge of this, that also a big video is there on RBI circular of pre-shipment and post-shipment. That video also you can watch, and then this topic will be fully covered. And if you are completing this topic in exam, like if foreign exchange exam, if you are going foreign exchange exam, you will be getting around 5 to 10 questions from this topic. And in international trade finance also, this topic will be giving you minimum 5 to 8 marks. You will get from here. And mostly the questions will be case study based. The concept should be clear to you. Okay. So this is the end of the section 4.3. Next is 4.4, that is factoring and forfeiting. So already we have made this video on factoring and forfeiting. So we will not discuss here this, just in sequence it is available. So factoring and forfeiting are also important topic that you can just have a look from the study material. Okay. How it is working and all, that we have already discussed in one video. So there you can go and watch it. Okay. So other is letter of credit. This also section 4.5 is also discussed. That video is also posted in the content. Okay, that also you can go through. So this factoring and forfeiting is also part of both exam, and letter of credit is of both exam. Types of letter credit. This video is also available in separate. That also you can watch. Okay, that also we have put in the sequence. So here 4.6. 4.6 is bank guarantee and standby letter of credit. This we will be discussing in the next video. Okay. Thank you, friends. Thanks for watching. Have a nice day.